Well, I don't know about that, but I would say that there are two markets right now. There's what you see on the screen, which are all-time highs. The S&P 500 on Friday hit its 15th high for 2020 alone. But there are two very different markets right now. There's what you see on the market level, and there's what you see inside of it. And when you look inside of it, you see a violent rotation from the high growth, high multiple names to some of the reopen plays. So I would say that even though it's not the leaders that we've been accustomed to over the last few years, the Amazons and Apples of the world, which, feel exciting, and it's good to have that. 93% of S&P 500 stocks are above their 200-day moving average, which is by far the highest level going back to 2013. So we are seeing broad participation. It's just not quite as exciting when you're being led by names like CSX and Alcoa and Freeport-McMoRan. That's not the exciting type of a market, but things look pretty good from here.
I don't know. I think the industrial part of the economy is pretty exciting, but maybe that's just me. Jim Lacamp, I am curious, though. I mean, we're seeing not only the NASDAQ under pressure today, but also small caps again, which are down 2% and certainly lagging the broader market. What happened to this rotation trade we've been talking about for recent weeks?
It burned hotter and faster than it normally does. Why? Because we've got stimulus on steroids, we've got liquidity, we've got leverage, and it puts everything in launch mode, especially when you have consumers that have a very high savings rate, the highest in decades right now, and pent-up demand. So you see the consumers ready to go. You have tons of liquidity, tons of leverage, and we think it puts this recovery into launch mode in terms of how these stocks are going to cycle out. So our early stage economic recovery stocks, which include small caps, are going to get hurt by some of the internals that are already happening, including higher input costs and higher cost metrics across the board. So what really rallied off the lows were low quality stocks and small cap stocks, and that's what's getting hurt today. We're rotating out of those names already into the middle stage economic recovery type plays, which should continue to include industrials, materials, financials. I really like energy in here, and I think these plays that have really ramped up from the lows, especially from the September lows, like the small caps and the lower quality stocks, are going to take a backstage because the markets are already moving past mentally the early stage recovery plays into the mid stage recovery plays. And it might mean that the averages have trouble continuing to hit new highs as we continue to rotate. And I think we rotate into higher quality names, but only at reasonable prices. So they're going to avoid the high PE stocks, and they're going to avoid the low quality stocks all at the same time. It's going to make a stock pickers market, not necessarily a market for the averages.
Shepard Smith here. Thanks for watching CNBC on YouTube.